Hi, I'm Samir Jain. As we head into the long weekend, I thought I'll provide a quick take on the economy, on markets. Of course, these days, every week looks like a long weekend. A few hours ago, the August jobs report came out. Total non farm payroll rose by 1.4 million. The unemployment rate has declined by 1.8%, and the overall unemployment has fallen to 8.4%. So, this is all very good news because these are improvements that reflect the continuing resumption of economic activity in those states that have opened up. We've also seen an increase in government employment in August, but I think this is largely temporary because government hired a lot of temporary workers for the 2020 census. But and I haven't really parsed the press release in great detail because it just came out, but it seems that job gains have been across the board in the retail, in trade, in professional and business services, in leisure, in hospitality, education, health services, which is all very good news. And the labor force participation rate has also increased modestly, I think 61 point some percent, but it's still around 2% below the February level. Look up the numbers yourself because I don't remember the exact number. These things have just come out a few hours ago. So around 24 million people reported that they've been unable to work because either their employer closed shop or has lost the business because of the pandemic, which is not good news. That is because they haven't worked at all or they worked few hours at some point in the last 4 weeks. So I hope that changes. Around 5 million plus people are not in the labor force as per the numbers that have just come in or were prevented from looking for work because of the pandemic. Moving on to markets, the US tech sector has been on a tear. It's continued to support the large 5, 6, 7 firms, the S&P 500, which is at its all-time high. Today, I think it's 3,400-ish or so. It's almost up 9% for the year. So despite the corona crisis, despite the election uncertainty that's looming, the average portfolios have tended to be much higher overweight to growth style stocks. And growth this year we know has significantly outperformed value. Treasury yields are very, very low, 0.7%, and they are much below the effective rate of inflation. These are negative real yields. So low treasury, low interest rates, growth stocks trading at the highest valuation premium to value, investors moving into sectors with less structural sensitivity to the pandemic. All of these are very interesting developments. People are partial towards technology, towards consumer discretionary, towards healthcare sector funds, and you would see a significant dispersion in inter-sector returns, not so much intra-sector returns. So credit spreads have remained remarkably tight. We've seen a partial recovery. I've been reading some analyst reports and they predict that GDP will rise by around 35% in the third quarter. But even this rise will of course not make up at an annualized basis because we had a very terrible second quarter. And there is some expectation that with the winter setting in, GDP may still fall once again in the fourth quarter. The good news is consumer spending has surged, and it has been driven largely by the $600 weekly stimulus checks. So folks have been on a spending spree. But unless this is renewed, and it doesn't look like this is going to be renewed, this expiration of enhanced unemployment benefits will show up in slower consumer spending in the next quarter. Business investment spending, I don't see it pick up at all because there is much too much uncertainty from the consumer, from the corona crisis, I beg your pardon, from elections coming up in November, from politics, from the tension that we've seen ramp up with China. Government spending also will be low because the tax base has shrunk. We've had declining revenues in state and local governments. Budgets have shrunk. We've seen a lot of retrenchment happening. And one is not sure when, if at all, would one see a new stimulus being passed. Very little chance of that before the election. And overall, everything depends on the pace of developments in the vaccine. That is really the single most driver that will cause the US and the global economy to return to normality, and this isn't expected before the middle of next year. The silver lining is the US housing market. US new housing starts have gone up, and that's because it's catering to a pent-up demand because we didn't see too many housing sales in March, April, June, and historically low borrowing mortgage rates have been propping up the housing market. Here's the interesting thing, and I haven't really looked at these numbers, but corporate profits seem to be surprisingly good, all things considered. If you look at the previous recessions, the previous 8-10 recessions, corporate profits have fallen much lesser than the previous recession, and I don't know why. And I'm not questioning that either. It's a good thing. So profits are still down, but we expect that even in the best case scenario, assuming no increase in corporate taxes, operating earnings, at least for the large companies, won't of course exceed their 2019 peak for the next 1 or 2 years. So the market, the economy, all of these have benefited from the very lax monetary policy, from the largesse that we've seen from Washington, and all of these are good tailwinds. Of course, in the longer term, and when I say longer, I mean middle of next year onwards, we are building up some systemic risks, but that's something we really don't need to think about too much right now. The Fed has changed its mandate. It's no longer going to link it to the Phillips curve, where a drop in unemployment numbers fosters inflation. So they're not really going to measure themselves to that, and they're going to manage these rates that essentially is going to keep short-term interest rates extremely low, even if inflation creeps in the short term, and we don't see it creeping in at all over their sort of 2% number. So some people say we've had a profligate government, but I think it's exactly the right thing to do, to use every tool to stimulate aggregate demand. The Congressional Budget Office projects deficits to more than $3 trillion this year. The debt to GDP ratio is going to go up from 80-ish odd percent to 105% of GDP by the middle of next year. And if we have new stimulus, this number is in fact going to grow even higher. And if we have tax breaks, this number is going to be still higher. So that's something that is inevitable, but not in the short term. Not in the short term. We shouldn't worry too much about that. These stimulus packages are absolutely required right now, and I don't see the Fed decrease their $20 billion per week purchase of treasuries until next year. So the Fed is managing to its new inflation and unemployment targets. So we're not going to see any tapering right now. Nothing that's going to push interest rates higher, nothing that's going to push the cost of financing higher. So even though we have a swollen national debt, and one keeps hearing that on NBC, none of this is going to push tax rates higher, irrespective of who wins the November election. In foreign exchange, the G10 currencies have continued to strengthen against the US dollar. Emerging market currencies have weakened versus the US dollar, largely because this corona crisis is spreading in India, it's spreading in LATAM, it's spreading in Africa too. Overall, as I look and we have some visibility as active allocator into portfolios, so folks have tended to tilt to risky assets, to higher yielding credit, to growth equities. And all of this really is driven by very supportive monetary policy, which has been, as I said, a tailwind for both financial markets and for the economy. Even though most of us realize that some parts of the US equity market, some parts of high yield bond markets are now priced much too high. So to summarize everything, risk sentiment has improved. Everyone is a lot more optimistic as we go into these third phase of trials with the coronavirus vaccine coming out. In foreign countries, we've also seen some modest upside inflation surprises. Global activity data, largely because China has been pretty resilient, is of course a cause for concern, but nothing that would keep me awake at nights. Stocks have risen, bond yields have gone up for risky bonds. US stocks have outperformed emerging markets. The S&P is at record highs. We continue to outperform Europe, Japan, emerging market equity indices. Some yield curves for risky assets have steepened. Perhaps that's pricing in the prospect of modest inflation, though I'm not too sure that's really what's happening. So overall, to conclude, people are retaining tilt towards risky assets. They're overweighting high yield credit. They're overweighting growth equity. They're expecting monetary policy to continue to aid growth, to continue to push markets for the foreseeable future. There's a wider dispersion now between certain emerging markets, European indices, and people expect and anticipate a contained rise in real yields over the long term, but nothing unsettling for the medium term. So that's my news for today, and I'm signing off. Thank you for listening in. Bye-bye.